Nilesh Shah, Managing Director and CEO of Envision Capital, joins us. Let's take our conversation forward and understand where he's, in a sense, picking up the spots right now. Nilesh, this is not your office, right?
No, this is from home.
You were supposed to come to our office. What happened?
I guess there's no space in your office, so I thought I'll do it from my office.
अरे भैया आपके लिए तो हमेशा जगह है आप आइए
Thank you
नेक्स्ट
so much.
टाइम
Thank you so much, Nikunj. That's very kind of you.
Nilesh, it's not alarming, but it's getting sticky. Markets are hitting a pause button. Do you think we've done for the year in terms of a level, in terms of where market would settle at?
I would tend to think so, Nikunj, that we've had a sharp kind of an up move over the last 6 to 9 months. And so this calendar year, this financial year so far has been fantastic in terms of price moves, in terms of re-ratings, and then that's got backed by strong earnings growth as well. So on the whole, it's been a good time so far. In this year, probably for the first time, we are seeing some bit of chinks in the armor in terms of how the geopolitical equation now kind of changes or impacts macroeconomic stability, how crude oil behaves, impact on inflation, interest rates. These are the kind of challenges which could come to the fore, which can create some kind of pause buttons. But I think barring issues around sentiment, I don't think that we have any other kind of risks that we need to worry too much about. I think, yes, there's been a lot of talk about this whole geopolitical stuff. But if that were to have had an impact, I think it would have had an impact. It doesn't take kind of 1 week or 2 weeks for these kind of impacts. We've seen in 2022, the whole Russia-Ukraine stuff, and earlier on, there have been many geopolitical challenges the world has faced. That time, the market's reaction used to be very quick, very swift, and impactful. That's not the case so far. So maybe right now, yes, there are initial signs of worry, but I don't think it's something that I would be too worried about on a very extended basis.
So what, to your mind, could be the biggest moving part? Could it be interest rates? Could it be the dollar index? Or could it be crude once again?
I believe that of the three that you mentioned, clearly crude is the one which has multiple kind of impact. Crude obviously has impact from fuel prices, consumer inflation, interest rates, trade deficit, balance of payment issues, and then the currency impact. And that's also which basically also prevents a lot of fence sitters from basically putting money to work, especially international investors, because that's one of the key monitorables that they have always tracked for India over not just the last few years, but over decades. So that's been an age-old kind of a variable, which does move the needle, which does impact sentiment. So I probably think right now, it is going to be crude oil. And as long as we remain sub 100, I still think that's the kind of comfort zone. The moment we cross 100, it will start to tell in terms of sentiment, in terms of incremental flows, and eventually on margins of companies.
Why are private banks trading cheap? HDFC Bank, it's trading at valuations which are lower than what they were pre-COVID and pre-IL&FS, ditto for Kotak. And I can also say for Bajaj Finance, even though it's an NBFC. The growth is there. You have what we say sometimes a 6x6 visibility for next 2 or 3 quarters for these for this sector and for these names. Yet markets are giving them a stepmotherly treatment.
I probably think it's more got to do with the growth differential. The banking sector, the lending space, credit plays, they're all kind of growing and growing really well. The challenge is that the big banks probably are growing at about 15-18% versus that the smaller banks, the specialized credit plays, some of the NBFCs, smaller NBFCs are growing at least at around 25%. And in the process, they're continuing to hold on to asset quality. There's been improvement in asset quality, and there's been some expansion of return on equity as well. So market definitely gravitates wherever there is superior growth. And we've seen this not just for banking, we are seeing this for a whole bunch of sectors, including, say, for example, the IT sector, where the large companies are not able to grow or are growing in low single digits, versus that the mid caps, the small cap companies are growing at a much faster pace, or the tier 2, tier 3 companies are growing at a much faster pace. So I clearly believe this is a phenomena which we are seeing across sectors. It's obviously become more stark in the banking space versus other sectors, but I clearly believe it's more to do with growth differential. And as long as we continue to see growth differential coming in from tier 2, tier 3 companies or smaller companies or mid-sized companies versus their large cap peers, I clearly believe that that will continue to get reflected in the stock price outperformance as well.
Nilesh, what is the best way to approach this market? Raise cash because downside and better entry levels are coming, or stay invested but just prepare for a volatility? It will be volatility. There could be volatility, but no risk per se.
Nikhil, I don't think taking cash calls is going to help meaningfully or is going to help significantly. It may just be a more transient strategy, but clearly the bottom line is that the Indian economy is essentially going to continue to be a star. It's going to continue to be an outlier in the global context. Several businesses, several individual companies are performing extremely well. They continue to grow at a healthy pace. They remain capital efficient. And so clearly the long-term bull market is intact. Now within that, trying to kind of, tweak here and there with 5, 10, 15, 20% allocation may not really help. So I would probably still say stay the course, stay invested, just that remain bottom up focused. Don't just basically buy a stock because it is large cap or because it is small cap. I just think look at every individual idea more from a bottom up perspective, from a micro perspective. And if it's growing at a healthy pace, the balance sheet is intact, governance is intact, and if capital efficiency continues to be robust, I think you should be there. And as long as valuations you believe are reasonable, the price you're paying is reasonable from a medium term kind of a perspective, then I clearly believe that's the kind of strategy to follow.
So do you have less cash and more ideas, or it's the other way around for the first time?
No, I clearly believe right now, though, we continue to have a whole bunch of ideas. So honestly, we are fortunate that in India we have a universe which runs into thousands of companies. There are 3,000 plus companies listed, and of which at any point of time you always have a universe of 300, 400 companies which you believe meet at least the basic criteria. And from there you've got to pick maybe your 20, 30, 40 stocks and construct a portfolio. So clearly believe that right now the ideas factory, if I may use that word, the ideas engine, the ideas factory continues to essentially be very strong, very robust.
Okay, Nilesh, here's some data. I'm sure you've got this data. I'm just bringing it for the conversation here. If one looks at the historical average for large cap, mid cap and small cap, excepting large cap, the mid and the small cap indices are trading above the historical average. The mid-cap index is now trading at, Nifty mid-cap index is trading at 25 times, and the Nifty small-cap index is trading at 18 times, 19 times, which is above the 5-year average. So why should one buy mid and small-cap stocks when these indices per se, which is a reflection of the broader market health, they are trading at a premium to the historical averages?
Maybe Nikunj, along with this data point in terms of valuations, it might just be useful also to have data in terms of the growth differential. And currently, the mid-sized companies or the small-sized companies across sectors are having superior growth, and there is significant growth differential between large caps and mid to small caps. And that I clearly believe is essentially the moot point, number one. Number two, the balance sheets of mid and small size companies, the balance sheets of large cap companies were generally always very good. Clearly, mid and small sized companies, their balance sheets have improved quite dramatically, and they have deleveraged. In addition to that, there are a couple of other factors which I think are extremely important, extremely pertinent. One is the access to capital at an affordable cost of capital. I think for mid and small size companies has improved and improved quite significantly. Even over the last 4 to 8 quarters, when we have seen higher interest rates, it's not that the mid and small cap companies have to pay a lot more versus the larger companies, in the sense that they're not starved of capital. They still have capital and they're able to borrow at a reasonable price to fund their growth plans. I think clearly that is number one. Number two is with the help of technology, online, e-commerce, the access to markets has also improved quite meaningfully for mid to small cap companies. So I clearly believe that access to capital and access to markets has improved quite meaningfully for mid to small cap companies. And I think in a whole bunch of companies, the quality of governance, the quality of investor communication has also improved quite significantly. So I think there's a huge amount of improvement which mid to small cap companies have seen in terms of growth differential, in terms of respect for balance sheet, respect for governance, access to capital, and access to markets. I clearly believe that these are the 5 factors which are making a huge difference. And I don't believe that these factors are transient. These are factors which are very enduring, are very structural, and will continue to play out for an extended period of time, and will continue to play out for a multi-year horizon. So that to me is the big difference that we are seeing this time around. So just looking at premium valuations or valuations trading above long-term averages may not be looking at the entire picture in totality. It may just be looking at probably part of the picture.
You've given us the template. Why you should not be looking at just this P multiple and then taking a call. And I think that is such a great point. I mean, we can look at one data point and say, okay, this is what has happened in the past, so future it may happen, but conditions are different, environment is different, interest rates are different, and the investing environment is also very different. So our viewers, they need to understand here is that big money is always made when you buy good businesses and ride them for years. And that's the time you will change from stock market from just an income generator to a wealth creator. The stock market will only create wealth when you're spending time. When you buy a house, you buy it for 10, 15, 20 years. It's passed on to generations. That's the same thing, I guess, what Nilesh is also talking about, you should do in terms of the holding period. So Nilesh, अब तो भैया बात करते हैं template की. Now let's talk about the colors. Put that template which you made, the 5-point template, into individual names. Where have you been shopping and where are you picking some spots?
So Nikunj, of course, we continue to hold a relatively a focused portfolio, but it's a portfolio across sectors. And we have been liking names around capital goods, around defense, around auto components, the tier 2 banks, very specialized players in the financial space, which is online broking, online insurance. These are the kind of businesses that we have been owning. Also, our exposure to alcoholic beverages, we think that's a standout sector from a 5 to 10 year perspective. So that's the space that we have been kind of very, very positive about. Most recently, though, a lot of our new investments have been into more the technology space. I have earlier talked about the exposure that we've had to MapMyIndia, which is C Info Systems. Newgen is a company that we have liked and we've owned. They came out with some stellar numbers. One of our most recent additions has been a small IT services company called Datamatics. We clearly believe that in the case of Datamatics, they seem to be on a path of higher growth. They have reorganized their businesses, largely focused around digital and artificial intelligence, which I think will provide strong tailwinds for them to grow at an industry-beating pace. They probably still have some bit of margins to expand. They're trying to build an interesting products portfolio, which might kind of result into slightly non-linear growth going forward. And valuations are attractive. It probably trades in mid-teens in terms of trailing earnings basis. So I clearly believe that there are a whole bunch of sectors which we've continued to kind of be very positive about. But off late, it's just coincidental that some of our most recent investments continue to be around the technology space.
We had a conversation, Nilesh, which was centered around the fact that you need to buy specialized IT companies. I mean, you buy a SaaS company, you buy a company which essentially is giving more services rather than just IT services. So if that theme has to be applied, one is Datamatics, what else?
Datamatics is there. Newgen is there. I think that's again, they announced their results very recently and they came out with some stellar numbers, business growing like kind of in the 20s, which I think is quite phenomenal. We continue to like LTTS, though they have cut the revenue guidance, but I still believe that in this current environment, if a company is talking of growing at 17-18%, which is high teens, and sustaining margins at 18% in terms of EBIT margins, and it's got a phenomenal size. I mean, it's now almost a 45,000 crore market cap company. So to that extent, it's not like kind of some small company out there. These are the kind of spaces. If I look at each of these companies, they represent very specialized space. I mean, L&T is basically an exposure to the ER&D space. They keep working on software-defined vehicles, the whole transportation, mobility space, semicon. That's the kind of space that they've focused quite a lot on. Datamatics is trying to basically improve the digital experience that businesses worldwide provide to their customers and to their own back office operations. So that I think is an interesting space. They're also kind of working on essentially providing ticketing solutions to the metro networks, both in India as well as to metro networks globally. I believe that's again a very, very interesting kind of an opportunity. Newgen is again a very specialized product company focused more on the BFSI space, largely focused on India and Asia, but now trying to kind of make a dent or a headway into the US and Europe markets, which creates solid tailwinds. They seem to have a lot of wind in the tail, wind in the back, which is helping them to grow. So these are some really nice kind of opportunities which are there. And on top of that, MapMyIndia, which is more a domestic business, but clearly like the business that they run in terms of digital mapping solutions, in terms of IoT-led navigation solutions, artificial intelligence, drones technology for the future. The number of use cases which they can have probably can be quite phenomenal. So it's an opportunity which I think is like kind of probably spans across the next 5-10 years. Obviously, each of these businesses runs risks of competition or disruption and volatility in the external environment. These are the kind of risks and challenges which most businesses do face. I don't think there are exceptions to that. But on the whole, on the balance, I think these are nice businesses to own from a medium to long-term perspective.
Between 1st of Jan and 18th of October, have your top 3 holdings or top 5 holdings changed?
Not very materially, Nikunj. Not very materially. I still think we continue to own, the likes of Radico Khaitan, Angel One, PB Fintech, Mahindra Holidays. These have been some of our leading holdings. And Polycab. These are some of our holdings which we have continued to own. And we have not made any material change in any of these holdings.
Stocks like Polycab, Angel, they are up 70-80% from the recent lows. I mean, Polycab, the management was there in the morning, so we spoke to them. The stock is up 100%. What is forcing you not to book profits? I mean, these are good levels to book profit. Your investors would be happy. So what is giving you the conviction that there is some more juice left in the tank, or there's still more fuel left in the tank?
So Nikunj, over the years, one has learned that, downside protection or downside risks are also there, but you also have the risk of exiting a position too early just because it has done very well in recent times. My learning over several years in the markets is that as long as a business continues to perform well, it continues to deliver industry-beating growth, then you should essentially not be in any kind of hurry to exit, because it still can be a compounding opportunity, for a slightly extended period of time. We've seen over even the previous decade how a lot of growth companies got massively re-rated, and for periods like 10 years and all that, they give you annualized 40-50% kind of returns kind of opportunities. And anybody who took the risk of or took a call of exiting them too early missed out on, a very extended period of gains. So I think it's the same kind of mindset. So I think as long as a business continues to do well, it's not that just that the company is good. What I mean is that the business continues to grow and grow in double digits. It continues to grow ahead of the industry. It continues to sustain its market shares, and it continues to identify adjacencies to growth and optionality. If these ingredients are still there, then I think it just probably still is prudent to continue to own these businesses. It doesn't mean that therefore that we may not exercise an option to exit any of these names which I mentioned. It's quite possible a few days later or maybe a week or few weeks later, we may choose to exercise the option to exit. But I think currently we continue to essentially be reasonably satisfied with the way these companies are performing in terms of their businesses.
Okay, now liquor, or when it comes to buying the entire liquor space, some would say that, look, it's very simple. India will consume more, India will grow more, per capita will grow. Now that's a lovely macro thesis. But frankly, if I look at some of the liquor companies, they've had a lot of volatility in their numbers. They get impacted because of raw material. Growth is always in mid-teens. Even though we are looking at a complete change in terms of consumption pattern changes, market cap changes, and per capita changes, liquor companies are mediocre growth businesses. What gives you the conviction to buy a mediocre growth sector then?
So Nikunj, I think, and my view is slightly more long term. That probably for the next 5 or 10 years, I see liquor companies being able to kind of grow at maybe 15 to 20% on an annualized basis. There could be a few years, few quarters maybe where the growth may be slightly lower than that. But I probably think on a very 5 or 10 year perspective, they have enough tailwinds to grow at 15 to 20%. And then some of the liquor companies have faced margin pressures in the last 1.5 years because of rising prices of bottles and of glass and freight costs, transportation costs, rising prices of the core raw material and all of that. Some of them have also been expanding their capacities, have been building capacities, and therefore had to add capex and have taken some debt for that. But if you were to kind of look at, say, a next 5 to 10 years, say, for example, one of the homegrown liquor companies that we own, their margins have been around probably sub 10% in terms of the operating margins, EBITDA margins. I think over a 10-year period, can those margins go back to maybe 17, 18, 19%? I think so. So if you look at a 10-year perspective, revenues being able to grow 4x, even if the growth rate is 15%, and margins being able to double over a 10-year period. So if you have revenues growing 4x and margins growing 2x on a combined basis, the net earnings could potentially grow maybe even 8 times from here over the next 10 years. That's what I see in them. And it's hard to find businesses who can kind of, become 5 times larger or 8 times larger or 10 times larger over a 10-year period. I agree it's a slightly more long-term view, but that's also part of our thought process, and it's part of our investment strategy.
Nilesh, a lot of your peers would say we follow a simple policy, Sasta Sundar. It has to be a good-looking business, and it has to have a P multiple which is, 14, 15 times. The stocks which you've discussed, whether it is PB Fintech, Engine One, Radico Khaitan, Polycab, their P multiples are 40, 50 times. Now you're a value investor. How would you justify buying stocks which have P multiples which are 30, 40 times, even 50 times?
So Nikunj, maybe I probably just shared some. I mean, an Angel One probably is still trading at maybe 20 times, for example. So I think it's a whole range. I mean, we in our portfolio, we probably still have companies which trade at maybe even 15 times, and then there are companies which trade at even 40, 50 times. So it's a whole range, but I think on an aggregate basis, the composite P multiples of the entire portfolio is not at some massive premium to the market P, number one. And number two, Nikunj, in the market and in the world of investing, there are many roads to heaven. You pick your path, you pick your road. You do what works for you. And I think over a period of time, clearly buying growth-oriented businesses which are capital efficient and have a long runway of growth, I think it works as long as you're paying a reasonable price for it. I think our entry in a lot of these positions have been at valuations which were way more attractive. I remember, I think our first investment into Polycab was probably 3 years back towards the end of 2020, where we bought it probably at around sub 1,000 levels, 800, 900 rupees, when the valuations were in the teens for Polycab. After that, of course, Polycab has gained continues to do very well in terms of market share, has expanded margins, has grown in a very stellar pace, which has led to its re-rating. But our entry valuations were not very high. Now it can be very debatable whether at these prices are the valuations justifiable or not. But you always also need to take an overall portfolio approach, and you do what essentially works best for you.
Path to heaven could be several. That's a spiritual debate, Nilesh. But let me understand your path of becoming rich. What is that path which you're following?
No, I don't think you kind of have any path to richness or anything like that. You just keep doing what you like and what you keep enjoying. I think that's the bottom line.
The word rich, because that was an acronym I think we discussed several years ago. It was an acronym where you gave 4 stocks. So what's the new acronym now?
No, I don't think I have more names to share apart from what we have discussed, Nikunj. I think we've
So,
discussed a whole range of sectors, a whole range of companies, including our most recent investment. So I think, yeah, I mean that's where it is.
no large caps, Nilesh. I mean, every fund manager is saying the
Oh,
margin of safety is
no, no,
bigger in large cap.
So yeah. So I think we actually now like the large private banks, Nikunj. We like HDFC Bank. Honestly, I still believe that over say a 3-year period, HDFC Bank will grow earnings at 15-20%. I think the valuations are at maybe 16-17 times on a trailing earnings basis, though banks you look at more on a price to book basis. But so if over 3 years a business is going to grow at 20% annualized, and if maybe the P multiples go towards 20 times, I think it will give you nice, compounding kind of opportunity. Our most recent investment has been Kotak Mahindra Bank. Both HDFC Bank, Kotak Bank probably have been flat over the last 3 years. I'm quite sure the next 3 years could be a lot more enriching for investors in both these two very outstanding, very respectable names. So these are some of the names that we like in the large cap space. We like ICICI Lombard Insurance when you ask about a large cap name. Clearly like it. I think the quarterly results yesterday were good, and probably they are again poised for some industry beating growth from a 2 to 3 year perspective. So these are some of the large cap names that we like.
Nilesh, you've been very candid and very openly sharing your holdings and why you like them. So, just a disclosure on behalf of Nilesh Shah, whatever we've discussed, I think his portfolio has exposure to him. I'm sure his family and personally he may be owning some of the stocks. So, what we've discussed on the show is a pure narrative to discuss ideas which he's liking on. But when you're investing in them, please do your homework. Nilesh, fantastic to have you on ET Now. Thank you for joining us.
Thank you, Nikunj. Always a pleasure.